Joining me now to talk about this week's flurry of activity and the markets, how to invest right now, Charles Schwab's chief investment strategist, Liz Ann Sonders, joining the conversation. Liz Ann, always a pleasure. Good to see you.
Hi, nice to see you too, Maria. Thank you.
You've been focused on fundamentals, not all of this other noise, some might call it, in terms of impacting investors. Right. Tell us how you see markets right now.
So I think what's been missed in all of this flurry of activity and analysis of the short-term stuff, in particular the political uncertainty and Trump and Comey, is that I think this entire bull market has been driven by liquidity. So not just what was provided by the Fed through 3 rounds of quantitative easing and taking interest rates down to zero, but global central bank liquidity. And as a result, money supply is now close to about the same size as U.S. economic growth, meaning GDP. At the same time, it's growing faster. So you have excess liquidity. When you have excess liquidity, it needs to find a place to go, and it's found a place in equities. And then on top of that, more recently, you've had the turn in earnings, which I think has been the underpinning of the most recent move in the market. So I think that's really all that you've needed to be a recipe for a bull market. And I think this obsession over things like Trump and the short-term news, I think is noise more than anything else.
Yeah, because you look at the overall earnings picture, and that, of course, is the fundamental driver of equities. Yep. Earnings were up 15% in the first quarter, Liz Ann, and I understand for the second quarter, as it's kicked off already, we're seeing earnings up about 6% in terms of expectations. So a good backdrop for stocks.
Right. Absolutely, and I think when you look into 2017 for the full calendar year, you're looking at still double-digit earnings growth and a pretty decent picture into 2018. And back to the whole, political aspect and Trump. A lot of people make the assumption that if we don't get tax reform in 2017, if it gets pushed into 2018, that is a negative for the market and that we're going to have to see earnings estimates come down. But nobody has added anything into earnings estimates, not even into 2018, for things like corporate tax reform or even broader personal tax reform. So those estimates are clean of any of these pro-growth policies. So as a result, if we get them, it's additive to earnings. But if we don't, I'm not sure that's a big negative from a growth standpoint.
Okay, because I was making that assumption. A lot of people are expecting that we'll see a health care bill before the July 4th holiday out of the Senate, and that tax reform could get done this year. That, you believe, would be additive. Even though we're in June and there's some speculation, will they get it done, won't they get it done? If they get it done, you think that further boosts this market? So
if you purely look on the corporate side, where it's easy to do the math in terms of impact on corporate earnings, if corporate rates go down to leaving aside uncertainty about the border adjustable tax, but if corporate rates go down to 20%, that would add about 7% to S&P earnings in whatever year, of course, it passes. You double that, of course, if you go down to 15% instead of 20%.
Really great insights, as always, Liz Ann. Good to see you.
Thanks, Maria.
Thank you so much. Liz Ann Sonders, Charles Schwab.